Hello everyone, this is Ron Simplified Myers and I want to welcome you to Ron's Financial Corner. Today I wanted to talk about term life insurance. The reason I want to talk about that is because I know in these times a lot of families are struggling financially, and one of the major areas that people are putting a lot of money in is their life insurance. And a lot of people are doing everything they can to keep it because they understand that if something should happen to the breadwinner, which is the reason for buying life insurance, is they want to make sure that they at least make sure they're still protected in case something should occur, that we hope nothing does, but just in case. So understanding your life insurance to make sure you're getting the best program for the least amount of money would be important for all families. It always has been, should have been what's most important, but even now it's even more important. So real quick, there's people that are going to ask, what is the difference between term life insurance and what some people call permanent life insurance? The only difference, because term is the insurance element of all policies. I hope you guys understand that. Term insurance, because I'll repeat it, is the insurance element of all life insurance. The only question is not whether you should buy term insurance or not. The question is whether you should save money inside of your life insurance policy or outside of your life insurance policy. That's the difference. It's that simple. So let me cover real quick. There's four different types of term life insurance. The first one is known as ART, which stands for Annual Renewable Term. It just means that annually, which means every single year, you're going to renew, which is the renewable part, that particular policy, which is known as term. So if you think about that, ART just stands for Annual Renewable Term, but for you and I to understand, it just means annually I'm renewing my insurance. Now, because of that, as an insurance company, they're going to charge you a little bit more money every year. Why? Because you're getting older. The chances of something happening to you in terms of death are getting greater. So as an insurance company, they're going to charge you a little bit more money every single year to cover that risk. So that's real simply the way life insurance is based. It's that simple. It's whether you should add a savings to that or not. That's the only difference. But let me explain the other types of term, just because there are other terms. But the basis of life insurance, if you understand what I said, is annual renewable term. You're going to get older. The insurance company is going to charge you a little bit more money because of the risk that is being put on them as an insurance company. They're not going to take the risk. They're going to pass it to you as a consumer. Now, I know that sounds backwards because they're an insurance company. You would think that the risk is supposed to go to the insurance company. The reality is the insurance company takes premiums, but their intent is to insure people that they don't have to actually pay. And that holds true in all insurance. As you know, if the chances of you needing the insurance, I don't care if it's health insurance, car insurance, or whatever, if the chances of you using it are very, very good, you're going to pay for that possibility. So the good customers or the customers that they don't have to pay on are always the ones that's going to pay less. I'm not saying right or wrong. It is what it is. Now, the second type of term insurance is called decreasing term. Now, why would a person let their insurance decrease each year? Remember what we talked about in ART is getting more expensive every year? Well, people will say, well, I can't afford my rates to keep going up. Well, what the insurance company says, well, why don't we make your insurance decrease so that your premiums will stay about the same or maybe even go down a little bit. But if we let your insurance decrease, then you don't have the additional premium where they're going up each year. But if you think about that, isn't that annual renewable term still in effect? Isn't the insurance getting more expensive? That's why you're being asked to decrease it so that you don't have to pay more. But if you think about that, obviously it's more. That's why I'm letting it decrease. The reason I'm emphasizing that is I want you to understand all insurance works that way. You're going to get older. The risk is there. The insurance company is going to make you pay for that. And all we're doing with decreasing is saying instead of charging you more, we'll decrease your insurance to offset having to charge you more money. Now, what has come into place also, a third type of term is known as level term. Level just means I'm going to let my premium stay the same, and I'm also going to allow my insurance to stay the same. Okay, now how does that happen? Well, let's say you took a 20-year policy, which means for 20 years, my insurance is going to stay the same, and also my premium is going to stay the same. Now, if we remember what we talked about, ART, all insurance is going to go up every single year because the risk is there. What level term does is they figure out over a 20-year program, which is why we said it's a 20-year level term. They just figured out over the next 20 years, with rates going up every single year, remember all policies work this way, with the premium going up every single year, over the next 20 years, how much is it going to cost this particular client over a 20-year period? They figure out the rates, and then they average it out over a 20-year period, which is why your premiums will stay the same and your insurance will stay the same. The last type of program or term you're going to come across is what they call modified term. Well, if you understand the three I just talked about, ART, annual renewable term, decreasing term, and then you understand the level term, the modified just means you may have a combination of those particular three. You may have it for 3 or 4 years where the premiums stay the same, and then all of a sudden for the next 3 years it's going to go up, and then it may stay level for another 3 years. Then all of a sudden it may decrease in order to stop the rates from going up. But that's all modified term is. So again, if you fully followed me, there's only two types of programs. Term and permanent just means you have a savings program attached to it. My personal opinion is never, ever combine the two. Insurance is insurance, and investments are investments. If you want to invest, find investment vehicles, specifically where to put your money. And if you want to buy insurance, in this case life insurance, buy it in its purest form, which is term. The same way I always tell people, if you buy car insurance, you buy health insurance, you buy any other insurance, you never ever add a savings component to it. Why do you do it in the life insurance industry? And the reason is, for the company, it eliminates a lot of risk. There's money they can get a hold of if their company is hurting, and it makes it sound like it's a benefit to you. I hope that's very clear for you, that you fully understand term life insurance and understand it is the insurance part of all programs. The only question is whether you should save inside the program or outside the program. I hope you enjoyed this particular education. By the way, everything that I'm sharing with you here, I always like to tell people, it's not right, it's not wrong. It's just my opinion. Take care. Bye-bye.